all of your investments or savings of any kind, they're all going to fit into one of those three buckets, right? And you remember what we call them? We have the taxable bucket, the tax deferred, and the tax free, right? Now, where do you think most retirement dollars are sitting today in this country? It is going to be about 80% of all retirement dollars are sitting in the tax deferred bucket. Now, why is this so heavy and tax free is so light? We've got maybe 15% over here, and then you've got maybe 5% if we're lucky, people that have their money in the tax free bucket. And so as I explain this, we talk more about how you get your money into the tax free bucket. I'm going to go through a scenario or an example client. And as I do so, I realize everyone's situation is different, so it's not going to fit you perfectly. But I can promise you that there will be things conceptually that will apply to you specifically. And so we're going to start with a 50-year-old male and a 50-year-old female. Okay, married couple, the Joneses. And they are earning a combined annual income of $100,000, okay? Now they also have, in their combined IRAs, $500,000. They also have $100,000 in just a plain old mutual fund. That's their emergency fund. They're also contributing 10% into their 401k, but they're getting no match. Okay, they're also paying $2,000 a year for life insurance, and they're paying $4,000 a year for long-term care insurance. Okay, now what would happen if this couple walked into the traditional financial advisor's office? Now, when I say traditional, I'm talking about the mainstream tax-deferred paradigm mindset. Now, I can tell you, over the years, I've worked with many financial advisors around the country, and not only worked with them, but trained literally hundreds of them in various capacities. And so I'm very familiar with their approach and their mindset. So let me tell you how the conversation would go if the Joneses walked into the traditional financial advisor's office. They would say, well, congratulations, you've done a good job in saving for retirement. But as we look at this IRA, looks like last year all you earned was 7%, and we think we can get you 8%. So roll that over to us, we'll manage it for you. As far as your emergency fund, it's a great emergency fund. But in your mutual funds, you only got 3% last year. We think we can get you 5%. So roll that over to us as well, and we'll manage that as well. As far as your 401k with no match, keep on doing it. If you ever change jobs, give us a call. We'll roll this into that, get everything under one roof, maybe save you some break points, save you some fees. And as far as your life insurance and long-term care, not really what we do. But who are we to say that you shouldn't keep on doing it? And so that is the conversation that I've heard literally many, many times. Now, if this client was to come into our office, we see red flags all over the place. First off, I'm not too concerned about the amount they have in this IRA. I'm more concerned about what that IRA is going to grow to if it's growing at 8% per year. And so these folks are planning to retire at age 65. So what will this $500,000 IRA grow to at 8% per year over 15 years? Well, if we use the rule of 72, we take the rate of return, which in this scenario would be 8, we divide it into 72, and that tells us how many years for this to double. So this is going to double in 9 years, so we've got $1 million. By the time we get another 6 years, it's going to be about 1.6 million, okay? Now, that sounds great, right? But what's wrong with having 1.6 million in your tax-deferred bucket? Right? It's the taxes. the minimum required distributions alone on 1.6 million is going to put them in one of the higher marginal tax brackets, and which is also going to pretty much guarantee that their Social Security will be taxed, in perpetuity. And so what we might suggest, or what some people may suggest, well, why don't we do a Roth conversion, right? So a Roth conversion says you can take money out of the IRA and convert it into a Roth IRA. So long as you do what along the way? Pay the tax. And at what rate? Well, it would be whatever the tax rates happen to be in the year in which you make the conversion, right? So let's assume a conversion is going to be 40%. So what's 40% of 500,000? 200,000. Now, do Mr. and Mrs. Jones have an extra $200,000 lying around that they would just love to earmark to pay this bill? No, they don't. And so now some might suggest, well, why don't we just take the tax right out of the IRA? And what would happen if we did that? It's pre-59.5, so we're going to have a distribution, which would be a 10% penalty on top of the tax. And so it's really not feasible at this stage of the game for them to do a Roth conversion. And so is there any other way that we can get money out of the tax deferred into the tax free? So at this point, we may recommend what we call a 72T. It's a little known section of the IRS tax code, section 72, subsection T. And what it says is that we can take money out of an IRA pre-59.5 with no penalties, so long as we do it in even yearly installments for at least 5 years or until age 59.5, whichever is longer. And we can take out about 5%. And so what is 5% of 500,000? 25,000. And so we're going to send that 25,000 each year to the tax-free bucket, okay? So let's look at this $100,000 they have in mutual funds. This would be in their taxable bucket. And so if this is their emergency fund, do they have too much or too little? And probably too much. And so based on their annual income, looks like the right amount would be about $50,000. And so because it's in mutual funds, means the problem's getting bigger each year. So what we may recommend is that we capture all of the growth and part of the principal, and we shift it to tax-free each year until, we do that such that when they reach 65, they end up with the perfect amount. So based on a 5% return, that's going to come out to about $6,000 per year. All right. Now, how do we feel about 401ks with no match? Now, this is the one thing that Susie Orman, Dave Ramsey, Clark Howard, they can all agree upon. And that is that we contribute into a 401k up to the match, but not one penny above and beyond. And so we want to do whatever we need to do to get the free money, but then move on to our next best option. And so if we're trying to prevent this IRA from getting any bigger, and we're contributing to a 401k, are those two strategies conflicting? I mean, that's a conflicted strategy. And so because there's no match, we're going to capture all 10% of their 100,000, so that'd be 10,000 that we can also shift into the tax-free bucket, okay? So how do we feel about life insurance and long-term care? Well, we feel that it's incredibly important to mitigate against those two risks, which could really upset your financial apple cart leading into retirement. But we feel like there's probably a better way to accomplish that. And so we're going to send that to tax-free as well, all 6,000. So how much did we free up on an annual basis that we can shift to tax-free? $47,000. Now, we don't really have $47,000 because we have some taxable events here, right? This is a taxable event, and this is a taxable event. And so if we add those together, that's $35,000 of additional income. And so we'll assume a 30% rate. So we're looking at $10,500 of additional tax. Now, do Mr. and Mrs. Jones happen to have an extra $10,500 that they would just love to pay each year in tax? No, and if I were to suggest to them that they cut back on their lifestyle, stop eating out, stop going on vacations, are they going to be my friend for very long? No. And so what I'm going to recommend is we take that $10,500 and we subtract it right out of the $47,000 that we freed up. So that way we're going to have no out-of-pocket expense and we're not going to impact the current lifestyle at all. That's going to leave $36,500 that now we can shift into tax-free each and every year. So the big question here, where can we put this $36,500 to where it can truly grow in a tax-free way? Now, the first thing I'm probably going to recommend is a Roth IRA. Now, if this scenario was a little bit different and the Joneses happened to be business owners, then I would take a hard look at their 401k, and I would probably recommend that we upgrade and improve his 401k plan to include a Roth 401k. And not only that, but to give him a better selection of the underlying investments that so he can have some protection against market fluctuations. But that's not our scenario. And so we're going to recommend funding 2 Roth IRAs. And so how much can 2 50-year-olds put into a Roth IRA? Well, it's going to be $6,500 each for a total of $13,000. So if we take that off, it's the 36, it's going to be $23,500 that's left. Now, why do we like Roth IRAs so much? And the reason is because as long as you're 59 and a half, when you start taking money out, there's no circumstance in which you would pay a tax. Not only that, but the money coming out of a Roth IRA is not going to impact your Social Security. It is not going to cause your Social Security to be taxed like the tax-deferred accounts would. Now, where can we put this $23,500 such that it grows in a truly tax-free way? Now, at this point, I may recommend a bucket. And as we start putting money in and your bucket begins to fill, as your money grows in this bucket, the IRS says that they're going to treat it differently than all of the other buckets we've talked about. They're going to say that if you want to access this money pre-59 and a half, you can do so with no penalty. Can you do that with your 401k or your IRA? No. They're also going to say there are no 1099s, which means there's going to be no tax on the growth. And then when the money comes out, they're going to say there is no tax, which means this is truly a tax-free bucket. They're also going to say that there are no contribution limits. What were our contribution limits on the Roth? $6,500 per year, right? Per husband and wife. They're also going to say that there are no income limitations, meaning regardless of how much money you make. So let me ask you a question. Can Bill Gates do a Roth IRA? No, he cannot. Why? Because he makes too much money. As soon as, if you make more than north of about $184,000, then you're phased out of your ability to contribute to a Roth IRA. So no income limitations. And then last but not least, they're going to say no legislative risk. So what do you think I mean when I say no legislative risk? Basically meaning that if you have the bucket, you get to keep the bucket, regardless of what laws might change. So the laws for this bucket, they have changed 3 times since 1982. And every time they simply said, if you have the bucket, you can keep the bucket based on the old rules, and the new rules only apply to the new people from this point forward. And so what do we call that clause? We call it a grandfather clause, right? So as you look at this, you might say, well, wow, this sounds incredible, almost too good to be true, right? Why don't I just put all of my money into this bucket? Well, first off, is it ever a good idea to put all of your eggs in any one basket? No, it's not. And also, the IRS says if we're going to give you basically an unlimited bucket of tax-free dollars with all these benefits, there is going to be a cost of admission. And we are going to require that there be a spigot attached to the side of this bucket on which flows on a monthly basis some expenses. And what do those expenses go for? They go towards the cost of life insurance. Now, let me ask you an important question. If you're rapidly heading into retirement, your mortgage is paid off, your kids have all moved out, is life insurance really all that high on your priority list? Probably not. And the companies that sponsor these programs, they recognize that. And so they've done something to sweeten the pot. They simply say that should you need long-term care, they will give you your death benefit while you're alive for the purpose of paying for it. So let me give you an example. Let's say you have $400,000 of a death benefit. They will give you 2% or $8,000 per month for 4 years for the purpose of paying for long-term care. Now, if you have looked into traditional long-term care, then you know that it can be quite expensive. And it's the percentage of people who are going to need long-term care in America, it's about 70% will end up needing some form of long-term care. But what if you pay for 20 years and then you end up dying peacefully in your sleep? Are they going to send your money back? No. And so that can be a source of heartburn for a lot of people because we don't like paying for something that we hope we're never going to have to use. But in this scenario right here, if we pay these drops for 20 years and then you die peacefully in your sleep, never needing long-term care, someone of your choosing is still going to inherit the death benefit. And so we don't have this sensation of paying for something that you hope you're never going to have to use. So what do we call this bucket, by the way? We call it an LIRP. Stands for Life Insurance Retirement Plan. Why life insurance? Because the IRS says that in order for this bucket to work, there has to be a cost of insurance coming out. Why retirement plan? Because the whole purpose is that we have a large bucket where we can accumulate tax-free dollars that you can use at some point down the road when tax rates are likely to be a lot higher than they are today. So now, have Mr. and Mrs. Jones, have they already decided that they need and want life insurance and long-term care? Yes, they've already budgeted for it. And so all we're suggesting is that instead of sending the $6,000 off in the form of an expense every month, why not divert that into their tax-free bucket, let just a portion of the expenses drop out, and then take advantage of this huge bucket of tax-free dollars that they previously would not have had access to. Now, before I go any further, I have a very important question to ask. And the question is this: if you could be in any tax bracket of your choosing during retirement, which bracket would you choose? Now, it may not have even occurred to you that a zero tax bracket even exists, or that it would even be attainable. But it does, it is, and it's vital to protect your retirement dollars. And so if getting to the 0% tax bracket is our goal, let's see how we have done here with Mr. and Mrs. Jones. Okay, we know that they're putting $13,000 into the Roth IRA each year, right? So as long as they're 59 and a half or older before they start taking money out, will they pay tax? No tax. The LIRP will have quite a bit of money coming out of it by the retirement age. And regardless of what age they start taking the money, will there be any tax? No tax. Okay, so now they've got this IRA, so let's come back to that. You remember, we did not want the IRA to get any larger inside of the tax-deferred bucket, right? And so if we did a good job, how much should be in that IRA at retirement age? It should be $500,000, right? Now, is there any way that we can take money out of this IRA and spend it in retirement without paying a tax? Now, if you remember, absent any deductions, if we were to retire today, you would get a deduction, right? It's a standard deduction plus personal exemptions. For a married couple, it comes to $21,000. And does the IRS index that number for inflation each year? Yes, they do, about 3%. And so in 15 years, this number is going to be a lot closer to $30,000. Okay, so how much money can Mr. and Mrs. Jones take out of their IRA in retirement and pay no tax? Up to the $30,000. Okay, so we now have an IRA with no tax. So if we have no tax, no tax, no tax, what do you think that impact that has on our Social Security? No tax. Okay, so if we have no tax, no tax, no tax, and no tax, what tax bracket does that put us in? 0%. Now, why do we make such a big deal about the 0% tax bracket? Because what's the next best tax bracket? It's not 1%, right? As of this year, it's 10. You add another 5 for state, and you're looking at 15%. So that's the next best thing. And then if what David Walker says is going to happen comes to pass, and tax rates double in the future, now we're looking at 30%. And so the next best option is really not looking all that great. Now, are we suggesting that you put all your eggs in any one basket? No. What we're suggesting is that you have multiple streams of income, all of which are underneath the radar of the IRS. Now, what I did for Mr. and Mrs. Jones is I created a before and after. Now, you've probably seen diet photos of before and after. Well, we can do the same thing with your retirement projections. And so Mr. and Mrs. Jones, if you take a look here, we ran a scenario saying, what if Mr. and Mrs. Jones never met us? And they just continued to do what they were going to do. When would they run out of money? And this is assuming that tax rates stay the same, no change. They would actually run out of money at age 88. However, you can see the difference here in the two graphs. If they were to implement everything that we've recommended, and still assuming the tax rates stay the same, how much can we increase and extend their retirement dollars? And they basically never run out. The money goes well past their life expectancy, and they will have money left over. Now, what would happen if tax rates do increase? So if tax rates double, they're going to be running out of money closer to age 77. And what happens to their, on this column, if they do implement this, if they're in the tax-free or the 0% tax bracket, what happens if tax rates double? Absolutely nothing, right? 2 times 0 is still 0. And so when you are in the 0% tax bracket, you are effectively off the train tracks, right? And you are isolated. And you have protected your retirement dollars. So it doesn't matter what the tax rates do at that point. Now, one of the questions that I get from time to time is, can I be a good citizen and be in the 0% tax bracket? Now, are we suggesting that you never pay taxes? No. All we're suggesting is that rather than delaying or deferring or postponing the payment of taxes in retirement when tax rates are likely to be much higher, that we actually pay them now while tax rates are historically low. It actually, Mr. and Mrs. Jones, they're going to be paying $10,500 in taxes just to get to the 0% tax bracket. Now, I have a quote here. This is from Learned Hand. He's a judge. He's the most famous judge to never be on the Supreme Court. He said, anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the treasury. There is not even a patriotic duty to increase one's taxes. Over and over, courts have said that there is nothing sinister in so arranging affairs as to keep taxes as low as possible. Everyone does it, rich and poor alike, and all do right. For nobody owes any public duty to pay more than the law demands. So, can you be a good citizen? And can you be in the 0% tax bracket and still be a good citizen? Absolutely.